In this video, we're going to talk about what you need to do to prepare to buy a house in 3 essential steps. So what are the 3 essential steps? Maybe, you're thinking of buying a home, you're not sure if you can afford one, or, maybe housing prices are too high right now and you're thinking maybe I should wait, or should I get in, or you're not sure about it. So if that describes you, then this video is for you. We're going to get into what you need to do to prepare. There's 3 essential steps you must take if you're thinking of buying a home, which can be absolutely the best decision you ever make in your life. Okay, so that's what we're going to talk about in this video, so let's get started. All right, well, the first thing is, the housing market right now, it's the beginning of 2023, prices have been going up. Appreciation of housing prices is normally around 4% every year. However, in the last 2 years, prices have appreciated by about 30%. That's huge. So we've seen a massive increase in prices. A lot of people feel they're basically priced out of the market right now. A lot of buyers are putting their plans to buy on hold. So, maybe that describes you, or maybe you're not sure, or, you're kind of sitting on the fence. So, the first thing that you should do if you have a desire to get into the housing market, and if you're thinking about that, I really encourage you to do that. That's going to be one of the smartest decisions you're ever going to make in your life. So, the first thing you really want to do is go and talk to a good lender. And this should not cost you anything. If you want to go talk to a lender, and I don't mean necessarily like your bank, I mean like a mortgage specialist, someone who specializes in helping people get financing for homes. And if you don't know anyone, hey, check the link below. I've got links below where you can contact me and I can refer you to good lenders. I don't make any money doing this. It's just something, part of I'm a real estate agent here in Las Vegas, and any good realtor is going to have, resources for you as a buyer or a seller in terms of people that we can refer you to, good lenders who you can work with, and all that kind of thing. So check the link below, if you need to talk to a good lender, and if you're not sure, send me a message. I'll definitely refer you and set you up with someone you can chat with. So, that's really important. And, when you do talk to them, one thing you're going to get an idea of is, how much house you can afford, what you'll be eligible for, or whether you even are eligible. So there's 2 sides of that equation that you might fall on. One is, after you talk to a lender, you might discover, hey, we can actually afford to buy a house, this much, and we didn't realize we were in that position, and that's really great to know. And then at that point, you can go forward and take the next step in that whole journey. Or you might fall on the other side of the fence where you find out, hey, I thought maybe we could get a home, but it turns out our credit score's not so good, or, we need to work on, debt to income ratio. And if you're not sure, how those things affect your ability to buy a house, well, that's what we're going to actually talk about a little bit in this video. So stay tuned. Okay, so let's say for the sake of this video, that you fall into the camp of, hey, we actually need to do a little bit of work to get ourselves to prepare to buy a home. And so the first thing, you need to do to prepare to buy a home, whether you're thinking, maybe 6 months down the road or 12 months down the road, let's think about buying a home. You're sick of renting and you really want to make that journey, or maybe you want to buy a second home, or maybe you want to buy an investment property, and you're just not quite ready to do that yet. Well, what are the steps? Well, the first step is really what you call how much house can you afford, just determining how much house you can afford. And there's 2 aspects of that. One is your down payment, and the other is creating some kind of budget. So that's a really big critical first step. And so what's involved in that? Well, the first thing is, there's a lot of misconceptions out there amongst first-time home buyers and other buyers about, I need to get 20%, of a down payment, of the house price. So let's say, right now the mean average price for a single-family home in Las Vegas is around $400,000. So let's say you wanted to buy a house for around $400,000, and you're thinking, well, I need to get a 20% down payment, which is $80,000. Well, first of all, that is a misconception. That's not actually accurate. You don't need to get a 20% deposit. You can get as little as a 3% down loan, a conventional loan, and with an FHA style loan you could do 3.5%, and in a VA loan you can actually put 0% down. And that leads into a second misconception, which is, hey, I heard that there's some programs out there where I actually don't need to put anything down to buy a home. Well, that's not entirely accurate either. Now, that is true in some situations, and I just mentioned one, and that was, the VA loan program. You can be eligible for a VA loan, that's a Veteran Affairs, if, you're eligible for veterans benefits. So if you've been an active, service member of the military, or you've done, a number of years of inactive service, then you may well be eligible for VA benefits, and you could get the benefit of VA loan where you can put 0% down. But not everyone, in fact, the majority of people do not fit into that category. But there are some other programs around. For example, I had a buyer client who I was working with recently who was, in California. He was wanting to relocate here to Las Vegas, and he was working with a Bank of America lender in California, and they had a program where they would actually contribute $10,000 and even $15,000 towards down payment or closing costs. So he was going with that program, but there's a number of criteria you have to meet in order to be eligible for that program. And in addition to that, there were some guidelines where you could only buy housing with that program. It's called a DPA, which is Down Payment Assistance Program, in certain areas relative to what's called census tract data. So, when we were searching for his home, I had to go to a certain website where which is based on, the most recent census, that would tell you homes in this particular neighborhood, the income classifications of people living in that neighborhood were either classified as low, moderate, middle, or high income levels. And that DPA program was eligible only for homes in low or moderate income levels. So, that was another criteria. And, it turns out maybe, you don't really want to get a home in that area. So anyway, that's talking about down payment assistance programs, that they do exist, and it is possible sometimes to get, a home without having to come up with a down payment. But those programs are generally not for everyone, and not everyone fits into those programs. And even if you find one of those programs, you're still probably going to come up with closing costs. And if you're not sure what the difference is between a down payment and closing costs are, hey, I made a video just for you, so check out the link above right now where I go into what's the difference between a down payment and closing costs. So, and very briefly, down payment is obviously in a $400,000 house. Let's say you're putting 3% down. That means that's $12,000. Now that's separate to closing costs, and what closing costs are basically is when you finish a transaction, there's going to be a whole bunch of people involved in making that transaction happen. There's going to be lenders, people who lend you the money. There's going to be, people who do an appraisal on the property to find out what the right value of the property is. There's going to be escrow companies, and what they do is they hold money on behalf of a buyer and a seller. And so in other words, there's a lot of people involved in a real estate transaction, and they all need to get paid for their services. And so that's a lot of what closing costs are, and they're separate to your down payment. Your down payment, if you're buying a $400,000 home and you're putting 3% down, what that means is after you put that down payment down, you obviously now only owe 97% of the property. So $400,000 home, you put $12,000 balance of $388,000. So that's kind of the way that all works. So the point here is, the number one thing we're talking about, how much home can you afford, and the two parts of that is getting a down payment together and budgeting. So right now we're talking about the down payment. So let's assume that you are going to qualify either for an FHA loan where you need to put 3.5% down, or a conventional loan where you need to put 3% down. So if let's go for the lower 3% down, you want to buy a home for $400,000. That means you're going to have to come up with a down payment of $12,000. In addition to that, you're going to have to come up with closing costs, which are almost going to be the same amount again. Let's say $10,000, just for argument's sake. So you're going to have to come up with $22,000 to close the transaction for your $12,000 down payment and $10,000 of closing costs. So no matter which way you think about it, if you're going to buy a home, you're going to have money set aside, saved up for to close the transaction and to buy the home. So that's step one, getting a down payment together, and that's how that leads to knowing how much house you can afford. Let's say right now you have $5,000, or maybe you don't have any dollars and you have a goal of, I'm going to save $5,000 by the end of the year. Or let's say you get to $6,000. Well, $6,000 at the 3%, if you wanted to do a 3% down payment, would give you the ability to buy around $200,000 of home. So you can kind of figure out, the more money you have saved, the more house you can buy. So that's why down payment is the first thing you need to think about in terms of buying a home. You need to save money, and that leads naturally into the second part, which is when you're thinking about how much house you can afford. So we're just gone over why, how you can figure out I need to save for a down payment and closing costs. The next really important thing is budgeting. You need to learn how to budget to save money. And here's another important thing. When you go and talk to a lender to say how much, based on my income and my credit score and based on, my debt to income ratio, how much house can I afford? How much are you willing to lend me? Which is called a pre-approval. You get pre-approved for like a $400,000 loan or whatever it is. Before you even do that, what you really want to do and avoid a big mistake is figure out your home budget. And what we're talking about here is, get a spreadsheet, sit down and put, well, what's my monthly income? That's in one column. So you know what your income is every month. Now you go through every expense you spend every single month. And that's going to include, obviously, your rental payment, but that maybe is going to translate hopefully into a mortgage payment. But separate from that, you need to calculate, maybe you have a car payment, and then you've got credit cards, maybe you have a student loan, then everything else. How much do you spend on gas every week? How much do you spend on groceries every week? How much do you spend on, maybe you go out and party or, socializing or whatever that is, or visiting coffee shops or, all those kind of social activities, or going to the gym, whatever it is. How much do you spend on all those different activities every single month? You need to, put that down in a spreadsheet until you get to the point where okay, this is how much money we're spending every month, and this is how much money we're making every month. Once you figure that out, you can say, okay, based on all that, we now have a good idea of how much we can actually afford to pay for a mortgage, which would be in place of our rent. So that's a really important thing, because when you go to a lender and talk to them and say, hey, how much house will you pre-approve us for? How much money are you going to lend us so that we can go out and buy a house? They're going to base that on your gross income, which is before taxes, and based on your credit score, which is going to pull up, your basic things like credit cards and any major loans like car loans and student loans. But when they do that calculation, they're not going to be figuring in things like, I mentioned, like, how much do you spend on gas, and how much you spend at the coffee shop, and maybe you have childcare, and how much you spend on groceries. All those items are not going to be taken into account. So, they might tell you, hey, we're going to pre-approve you for, the $400,000 that you're looking for, and that's going to give you a monthly mortgage payment of, $2,000 or $2,500 a month or whatever it is. And then, you might actually think, oh, that's awesome. But then when you go and do your household budget, you might realize, hey, you know what, we can only really afford, once we've paid all our expenses every month, to come up with about $1,800 a month. So you don't want to go and get a mortgage for $2,000 a month when really all you can afford is $1,800 a month. So that's a really important thing to do. Go and do that. Once you figure out how much you can afford and you're talking to your lender, maybe they say, hey, listen, we can give you, a $400,000 home. It's going to be like $2,500 a month or whatever they're saying to you. And then, or, $2,000 a month or whatever it is. And then you're going to say, well, actually, we can only afford $1,800 a month. So how much house does that get us? And they're going to say, okay, well, $1,800 a month, we can lend you, $380,000 or something like that. So that's a really important first step in preparing to buy the home. So step one, figure out how much house you can afford. And again, as I've just gone over, that's going to involve in figuring out your down payment amounts and doing a budget. And then to get back to the down payment, let's go back to the idea of a $400,000 home where you need to come up with $12,000 for 3% down for a down payment, and an additional, $10,000 to $12,000 for your closing costs. So that's around $24,000. Well, how are you going to save that money? Well, firstly, once you've created your household budget, which is step one, that's going to tell you some areas of your life where maybe you can save money. For example, let's say you go to the coffee shop every week and you spend $10 there every day, buying a coffee and a bagel and whatever else. Well, let's say you just stop doing that for a whole year. Well, that ends up being over $2,000 a year right there that you can save just by that one simple thing. And a couple other areas. Let's say you get a tax return every year and you get a couple $1,000s in a tax return. Put that all into a down payment. Don't go out and spend it on anything. Save that as a down payment. There's another couple $1,000s. Let's say you have a steady job and you get a steady income and you get a steady paycheck. Pay a regular paycheck deduction. Take 1%, 2%, 3%, whatever it is, out of your paycheck into a savings account, which is going to be your down payment. That's another source. Maybe you have a 401k or some kind of investment account or an IRA or something like that. You should consider pulling a whole bunch of money from that account into a down payment, and you can think of it as one kind of investment into another. So there are some sources I've just told you where you can start to get a serious down payment together. That is step one. Figure out how much house you can afford, get your down payment together, or start saving for your down payment, and get your budget, your household budget together, so you know really exactly how much money you can afford every month. Now, step two, and this is really, really important in terms of getting pre-qualified, getting a loan, and getting a home, and that is your credit score. Your credit score is a really big deal in determining if you can even get qualified for a loan, and if you do get a loan, how much your monthly payment is going to be. And so why is that? Well, the first thing is, if your credit score is high, and a good high credit score is, over 700 and even up to 800 is a great credit score. A low credit score is between 500 and 600 is not considered a good credit score. So, and if you don't know what a credit score is, it means maybe you don't even have, some people choose a path where they don't want to have any credit cards or car loans or anything else, which means maybe you don't even have a credit score. I've actually, worked with people who didn't have a credit score, and it's very difficult to get them financing to, get a home loan or even to get a rental property. So, that's a whole nother subject, but basically if you don't have a credit score, the first thing you want to do is get yourself some credit cards, and, it might be difficult even to get a credit card. Credit card companies are unlikely to give you a credit card if you don't have a credit score. So then you're like, well, what the heck do I do? Well, you can actually get some credit cards, through banks where the credit card's tied. It's more like a debit card where, that's what I did when I started my credit journey. I got it was a credit card, but I had to put $1,000 in a bank account, and then I had $1,000 on that credit card available to use, so it was secured. And then I used that credit card that was technically kind of more like a debit card, and then I just paid that, whatever my balance was, every month. And so I began a credit history. Every purchase that I made, I just used that card for all my grocery shopping and everything else, and gas, and I began my credit journey and getting credit scores, and now I have a really great credit score. I've had loans and I've paid them off, and I've had credit cards, and my credit score's over 800, so it's easy for me, if I go to want to get a loan or talk to get a good deal, you're in a good situation in that place. But I wasn't always in that situation. There was a point in my life where I actually didn't have a credit score at all. So I'm just sharing, that's the journey. If you need to make, start making it. Now the other side is maybe you have a credit score, but it's just not too good. So, we're going to go into talk a little bit about how to improve that. But just to to give you an idea of why it's so important is, let's say you're getting a loan for $400,000 for a $400,000 home, and your credit score is around 800. Then what that means is the interest rate that they're going to charge you in your mortgage is, let's say right now the mortgage interest rate, it's around 6.5. Let's say you get an interest rate around 6.1 or something like that. That you're going to get the best interest rate possible with a high credit score. And so that means, you know, your monthly payment's going to be, maybe it's going to be around $2,000, $2,100 or something like that. Now let's say your credit score is not 800, let's say it's more like 600 or 640 or something like that. Well, at a 640, you're going to, instead of getting an interest rate of say 6.1%, you're going to get an interest rate of around 7.1%, a whole 1% higher. What does that mean? Well, that means your monthly payment is going to be about $200 more. Because you're charging more interest. So, you know, that's the way, if you don't know, that's the interest on a mortgage is the money that the lending institution makes for lending you the money. I mean, I know that's pretty obvious, but some people might be watching this and they're not sure what it's all about. If that's you, that's what that's all about. So the higher the interest rate is, it means the more money that the lender is going to make from giving you a loan. So when you have a high credit score, what that means is that you are a low risk to the lender, which means, like, if we lend this person money, they're almost certainly going to pay it all back, and they have a great history of paying all the money back, so we'll give them a low interest rate. However, if you have a low credit score, it means you're a higher risk, so they're thinking, well, they have a low credit score, which means they may not pay the money back. We might lose money against them, so we're going to charge them a higher interest rate for lending them the money. That's kind of the whole system works. So your credit score is really integral. So just think about that. If you're struggling with your budget, which we talked in step one is getting a down payment, and part of getting a down payment is budgeting, you know, figure out how much money can we afford each month. Well, if, let's say it was $1,800 a month, well, if you have a high credit score, that means, you know, your mortgage payment's going to be the lowest amount possible. But if your credit score is low, that means you're going to be paying an extra $200 a month on the loan payment, which means, you know, you can actually afford less home, you know, because you're eating up more of that $1,800 that you budget each month on that higher interest payment. So get your credit score, you know, improve your credit score is a really important part, and is step 2 of what you need to do to prepare a home. And so, you know, let's talk a little bit about that. How can you improve your credit score? And there's a few key things you need to do here. Firstly, let's say you have some credit cards, and let's say you have a credit card, $5,000, and let's say you've got it almost maxed out at $4,000. Well, that's 80%. If you had a $5,000 credit card and you've used up $4,000 of that credit card, that means your credit card's maxed out to 80%. You might think, oh, that's really good, you know, I've almost used that credit card, I'm making the minimum payment, but in terms of a credit score, that's really bad, because what the people who do the credit score see you as someone who's very highly leveraged and high risk, because you're kind of maxed out on your credit almost. So and maybe you're thinking, well, I can't really, you know, I don't have the money to pay all that off. That's why I'm making the minimum monthly payment. So what can I do? Well, here's one thing you can do. You could go to the credit card company and saying, hey, could you increase my credit card balance to $8,000 from $5,000? And, you know, maybe you're lucky and you have a good history of making your payments, and they say yes. If they do say yes, now you have an $8,000 balance, and you're not going to spend any more, but suddenly that $4,000 that you owe on a $5,000 credit card, which is 80% maxed out, has now changed from a $4,000 credit, you know, that you owe on an $8,000 balance, which means now you're only maxed out to 50%. So you increase your credits, you know, your credit availability, increase the amount of the credit card, and that lowers the amount, you know, that you're looking at. So what you really want to do is get your credit card, you know, the balance that you owe on your credit card, you want to get it down to around 30% if possible. So, you know, if you had a $10,000 credit card and you had $5,000 worth of credit on that card, you're maxed out to 50%. You want to try to get that down to $3,000. You want to pay off $2,000, so you get that credit card down to around $3,000, 30% of the $10,000. So that's the first thing you can do. Try to get all your credit cards, the balances, down to around 30% of what the card limit is. If you do that, you're going to increase your credit score. So, and if you don't do that, your credit score's, you know, going to be way down. So that's the first thing you can do. Just try to see if you can get a higher balance on your credit cards. Now, what's the next thing you can do is maybe you have a friend or a sibling or a parent or someone that you know who's near and dear to you that has a really great credit score, and they really use their credit wisely. They got a credit card with a very low balance, and maybe, you know, you could ask them, would they consider putting you as, you know, give you an authorization to use that card as well. So your name also gets put on that credit card. Now maybe you come to some agreement where, you know, you're really not going to use that credit card. It's just to improve your credit score, you know, or if you do, it's just for a very minimal amount of, you know, something that you agree to. Like, don't get on someone else's credit card and max out the credit card, in other words. Apart from, you know, maybe losing a friend or a loved one, it's not going to do your credit any good. But to fix your credit, that's another option. Get on someone else's credit card that's really good and has a low balance, not really use that credit card too much, you know, just a little bit, and then that'll help boost your overall credit. That's the second thing you can do. And then the third thing you want to do is thinking about just honestly getting your credit card balances down to zero. And that might be a big struggle for you, but and you know, they call it the snowball effect. One way you can do that, let's say you had 3 credit cards. One was maxed out at 10%, one was maxed out at 50%, and one was maxed out at 80 or 90%. Well, how do you do that? You're paying a minimum balance on them all, right? Well, what you want to do is get the lowest balance, the one at 10%, pay that one off first. Just works, you know, save a bit of money and just pay that one off right down to zero. And then the money that you were paying, you know, that credit card, your monthly payments on that card, you don't have to pay anymore. Put that towards the next one. Put that towards the 50% one. Then you get that 50% one paid off, and now you have 2 credit cards down to zero, and you're not making any payments. But the payments that you were making on all those 3 credit cards, you know, now put them all onto the highest one. So that's why they call it a snowball effect. You pay off one, and the money that you were paying that one, you put into the next one. Then you pay that one off more quickly. Now you pay 2 off. Then the money that you were paying off those 2, you put onto the next one. So you just go, you know, it's like a domino effect or a snowball effect. So that's another way, you know, when you pay those credit cards off, it's going to really help your credit card balance. So there's some suggestions, you know, on one level of fixing your credit score is around your credit cards. Then another thing you can do, and it's kind of going to go into the next area, which is called the debt to income ratio. So this will be the third area. So step 1 was, you know, figure out how much can you afford, get your down payment and get a budget together. Step 2 is your credit score. Fix your credit score, you know, reduce your debts, especially on credit cards. And something else in terms of your credit score is, if you have any, you know, older collection debts, like medical bills, for example, that say like are 7 years old or something, you want to prioritize your payments, so you don't really need to worry about those older debts in terms of the immediate future. So what you want to do is pay your immediate debts off, you know, ones that are 2 months old or maybe a year old or 2 old, and really focus on them. And if you've got some older debts like medical bills or something of that nature that are like a 7, 8, 9, 10 years old, just put them on hold for a while and pay off the ones that are more recent, and that can also really help your credit score. So that's another tip right there. So that's, you know, trying to fix your credit score. The next thing is, like I was saying, is a debt to income ratio. What's that all about? Well, it's just like what it sounds about. And if you're unsure about all of this stuff, here I'm going to put a link to a video above, Home Buying Process 101. I go over all these different aspects, in some other videos, so check them out. Check the link above. There's a good video there, Home Buying 101, and we'll go through some of those things in more detail. But the debt to income ratio, it gets back to step one of this process where you looked at your household budget. You figured out every month I'm making this much money, this much is coming in, and every month this much is going out. And the money that's going out is going to a car payment, to a student loan, to X, Y, and Z. So when you go to a lender, that's what they're going to look at also. They're going to say, well, every month, let's just use we'll throw some hypothetical figures. Every month you're making $5,000. That's the money you're making in, and yet every month you're paying out $3,000 in debt. You've got a student loan, you've got a car loan, you've got credit cards maxed out, you've got some medical bills, you've got all these things going on. It comes to a total of $3,000. That means your debt to income ratio is $3,000 over $5,000, which is 60%. What you need to know is you need to try to get your debt to income ratio down to around 43%. So in that case, it would be, if you had $5,000 of income every month, you want to get your debt to income ratio under 2,500, more towards $2,300, $2,200 a month, something like that. And so that goes back to budgeting, but it also goes back to prioritizing which debts to pay off. And and there's another thing, a tip here is, let's say you have some student loans and you have a number of them, for example. Go talk to your lender and see if you can consolidate all those loans into one loan, one student loan, which is the repayment plan is tied to your income, which means your over monthly payment of all your student loans is now lower than what it was when you were paying all your individual student loans together. So that's another example of, talk to your lenders of all your different commitments and see if you can consolidate your loans and try to get a smaller, monthly payment. And if you do that, it's going to bring your debt to income ratio down. So, that's another real key area that you can work on to improve your ability to buy a home. And the basic way it works is the lower your debt to income ratio, the more house you can afford. So, let's say, again, you're making $5,000 a month. And let's say, you really didn't have that many debts. Let's say it was only, $1,500 a month, or $1,000 a month. $1,000 a month would be a 20% debt to income ratio. That would be really awesome. And in that case, the lender is going to say, yeah, we can lend you some money. And because you have such a low amount of debt, that means we can use more of your income towards your mortgage payment. And so the more amount of your income you can use to your mortgage payment, that means that more house you can afford. So the higher your mortgage payment, it means the higher the amount that they're going to be able to lend you. So, that's the way they all kind of works together. So anyway, I hope that's been helpful. That's kind of like a 1, 2, 3 process, 1, 2, 3 steps that you can take to get ready to buy a home if you're not quite ready, or you're thinking you want to buy in the next 6 to 12 months. So, briefly again, step 1, figure out how much you can afford, and that's going to involve creating a household budget, and then thinking about down payment, saving for a down payment and closing costs. That's step 1. Step 2 is work on your credit score, as we went over, work on your credit cards and prioritizing which debts you pay. And the third step is your debt to income ratio. Figure out how you can have, less money each month being in your debts and more money available in your income. So that's your 1, 2, 3 step. And so I hope that's been helpful. If you have any questions, hey, leave me a comment. I really love it when you leave me a comment, because I'll either try to answer it personally, or maybe I'll even make a video for you. So leave a comment below. I really enjoy that when you do that. And hey, if you found anything helpful in this video, do me a favor, smash that like button, and share the video around on social media, and hit the subscribe button so you can stay tuned for more videos which I'll be making. And I really appreciate you tuning in for this video, and stay tuned for the next video.